Well, good morning to everybody, and let me begin by thanking the Swiss Finance Council for asking me to moderate this discussion on the post-pandemic recovery economic stock-taking outlook projection, in particular because it is with two outstanding European leaders, Roberto Gualtieri, member of the Italian Parliament, former Minister of Finance of Italy from September 2019 to very recently, who was before, of course, a member of the European Parliament for over 10 years and chair of the Econ Committee for 5 years. And I think it's fair to say he's been right at the heart of every big financial issue in Europe for the last almost 2 decades. Second discussant is Axel Weber, the chairman of the board UBS AG, who's been in that position since 2012. And before that, he was the president of the Bundesbank from 2004 to 2011, a member of the governing council of the ECB. And I think it's also fair to say that he's participated in every single European and global financial institution at the highest level over many, many years. So both of you, Roberto, Axel, a very warm welcome to you. We're going to discuss the current economic outlook, the sustainability of debt, transforming EU recovery plans, phasing out public support. And may I begin, Roberto, by asking you, how do you see the economic situation in Europe at the moment? When I look at the forecasts, I hear 3.7% possible growth this year, but 6.5% in the United States. And the Financial Times headline this morning is, "Mind the economic gap, Europe and the US are drifting further apart." Could you begin our discussion with some thoughts on that?
Thank you, David. Thank you to the Swiss Finance Council for inviting me to participate to this conference. But indeed, the US fiscal response, and now we read that they are preparing a second step, is quite strong. And I think is a right one, is a good one. And of course, this makes even more strong the need for Europe to not change the course of its action, which has been taken since the beginning of the crisis, which has been, I think, successful, pretty successful, quite different from the previous crisis. It has worked, and we have a positive outlook, and I think this is remaining positive, even if in the short term, of course, we had to revise a bit downward some projections because of this third wave, because of these problems with vaccination. So, for instance, in Italy, we are a bit revising down. For first quarter, we expect a -1, and in general, we heard from Christine Lagarde that we expect the first quarter negative in the euro area, and we will go back to growth. So we now expect, for instance, in Italy around 4.24, which is a bit less than what we expected. But overall, I think we will be able also to overcome these shorter problems. And I think the very, very significant policy response should be continued, implemented. But this is working. This has been working, and I would say this was not, granted in the beginning. And in my experience, I could see how we have been able to change course very quickly and to move to an unprecedented level of coordinated policy response, which was based on regulatory changes, and then a monetary policy decision, and then the fiscal response versus national level, and then next generation EU, which is unprecedented, and it's has worked pretty well. If you come back to the data of Italy, all the projection expected the summer -12, -11, and they were right, because we had the stringency index the highest in Europe. We had the highest share of tourism on GDP. So this number were rational. We ended up with a -8.9, which of course is bad loss of GDP, but far better than all international forecasts. And it was because we had been able, notwithstanding having very high public debt, to deploy an unprecedented stimulus. We did 6% of fiscal stimulus. We did 10% of guaranteed loans, actually deployed, not the potential firepower was even higher. We had 17% of moratorium credit. So we have been able to keep preserve employment, to preserve the productive capacity. And so when we could lift the restriction in the third quarter, we had an incredible rebound. Then, of course, restriction come back, GDP goes a bit worse, especially for services, while the manufacturing is going pretty well. But we are sure that as far as we are continuing along this course of action, now when we will overcome these temporary problems, I think the recovery will be quite strong, and the decisions which have been recently taken are the right ones. If we look at what the ECB has decided last week and what yesterday the Eurogroup has decided, we know that it formally will be decided later, but the general escape flows will continue. Support measure will not be withdrawn prematurely. And so that's the right policy stance. And I want also to stress, because Elke was pretty right in saying also banks have been so far part of the solution and not part of the problem. And this is extremely important also for the recovery. Thanks also to the right mix of regulatory decision, like also very clever fine-tuning initiative, for instance, the CRR quick fix, just to make an example, and others, and the national measures. So we have seen banks in Italy lending to non-financial more than before, NPL going down, and even profitability at the beginning was good, now then declined, but because of provisioning, so it is a healthy thing. So so far they look pretty much part of a potential recovery. Of course, we have some buts, and maybe we will discuss them in the next round. First, we need to be strong. Even if we will not be able to arrive probably at the level of the US as a fiscal, but we need to keep it strong. But we need also to qualify the quality of those interventions, and to gradually shift also to measures that are really able to enhance our growth potential and address some of the structural problems we have. We have also to be prepared also the financial system to all the scenarios, even if I'm confident, and we have to address some of the problems that Elke mentioned. And so continuing with the policy mix, focusing better the measures, and of course keep vaccination. And I think Europe will be able to have a very good performance in the next 2 years. We will arrive to pre-crisis level of growth at the end of next year as Italy, and our forecasts, I will come back on that, are actually prudent, because if the policy mix will work at its maximum level of potentiality, we can have also very positive surprises.
Thank you very much, Roberto. It's good to hear your optimism about the policy mix. Axel, looking at this from your seat, do you see? Are you worried about the increasing corporate and solvency risk? What are the main risks you see in terms of damaging economic growth, and perhaps also this question about, when are we going to see investment really revive, and some economists think we're in a liquidity trap, a Keynesian liquidity trap. Would you agree with that?
Well, thank you, David. Also, it's good to see you and also Roberto well, and thank you for doing this. Yes, look, I think I can agree with both Elke and Roberto that the banking sector has weathered the COVID crisis quite well so far. No major concerns about the stability of the sector have emerged. Banks have provided the corporate sector with loans. It was helped by government-arranged programs, both on the fiscal side and on the central banking side. On the ECB's TLTRO, supporting for lending programs, also the government-sponsored guarantees. I think this was very similar in Switzerland. The banks have created three major flows to the financial sector. First one was using their own balance sheet for credit where their credit is at risk. The second was partially, and the last part was fully guaranteed government programs. We've done that, and actually, when I look at our balance sheet, we much more used our own balance sheet than actually putting out credit that was partially or fully supported by the government. So banks did play their role as lending into the economy. And in my view, I think this is increasingly also recognized the strength of the banking sector, not just by the people on this call, but also by the market. If you look at once the tail risks were removed, with vaccination being a better outlook in November, the underperformance of the banking sector relative to the overall market indices has really changed. And since then, banks have revalued quite positively and caught up with the general stock market improvement that we've seen. So I do think, to your question, look, it would have been way worse if we would have lost corporates on the way because they would have not gotten the funding. What we now need to sort out is who will be able to survive. So not having lost corporates because of liquidity issue was an important achievement, and all the programs rolled out, whether fiscal or monetary, were adequate in that sense. It could have done much more structural damage if we'd not reacted fast and bold. And I'm always in favor of extraordinary measures in extraordinary times, and this was exactly what was happening. What we got to watch is we don't keep extraordinary measures too long in place, even in normal times, because that will not create our ability to react in the future. And so for me, there's no room complacency at the moment. We know that NPLs and corporate bankruptcies are a lagging indicator in the business cycle. What we've seen in many of the expected credit loss provisions that banks have done, these are largely driven initially by model-based adjustments or by model-based provisions, which basically kick up because the economy fell. What is happening now, there will be migrations from model-based provisions to actual bankruptcy and the third pillar of that. And that is something that will happen with a delay. So you can already see that loan growth over the year has been pretty strong, but it's very weak at the moment. And I think the NPLs as a lagging indicator will tick up. I see two risk areas that I would like to briefly talk about. The first one is, most importantly, the financial state of the SME sector in Europe and in Switzerland. This represents around 60% of Eurozone GDP and 70% of Eurozone employment, and it is particularly weak. The smaller firms have much less ability to pull through this, and with the lockdowns happening, some of their business models are being challenged, in particular in certain sectors where it's, hotels, restaurants, mobility, you name it. There's quite a few. There's a large number of losers from this crisis, and there are very few winners. And the concentration of the risks in the area that was affected is very strong. As I said, 60% of the GDP, 70% of the employment. Should a large number of SMEs face bankruptcy issues, the fallout and the impact on the recovery will be quite substantial. Now, there's two benefits that we still have at the moment. First is, on the positive side, government support programs, such as the guaranteed loans, predominantly used by the SMEs, have been prolonged and not phased out. Second, most of these programs have a built-in repayment schedule that only kicks in a few years' time. There is no immediate repayment plan because we didn't know how long the crisis would last. So these kick in later. So the challenges will come later, and I think also some of the fallout will come later. And the SME sector is the key sector to watch. actually, I would like to make one brief remark. If you look at how the market is taking that, the huge boom that we've seen in SPACs, which is exactly a sort of a boom that could lead to a capital market avenue for small, medium-sized corporates, which they haven't had so far, which they might have to use in the future as lending and repaying loans becomes difficult. I think this capital market avenue will be important. And actually, that's where Elke, what she said before, if we face that risk, we better get ready with Capital Market Union as soon as possible, because that's a second funding vehicle we can tap rather than just loans and the repayments of loans. Getting new money in from the capital market may be a way to basically mitigate any potential fallouts on SMEs. The second part is, be aware that many of the short-time work programs and follow schemes that have helped to prevent a major rise in Eurozone unemployment. And that was the key problem last time around. Remember, unemployment in some countries fell, and unemployment rates went up to 25%. Youth unemployment was at 50%. We haven't seen that now because we've had these government support programs. And actually, if you look at real estate, if you look at corporate loans, the major reason for a default in the loan is an unemployment situation, or when it comes to real estate, a divorce. And so, the major reasons of why the loan sector might be sort of weak, we haven't seen yet. And unemployment is, whilst it's gone up, it's held up relatively well. And of course, with the speed of the recovery now coming, it is very important that as these programs get phased out, that they get phased out in an orderly fashion, and that the corporate sector participates in some of these programs. I, for example, like the French scheme, where basically the support by government for short-term work is phased out in stages, so it's not completely withdrawn, but first you pay 10%, then you pay 20%, eventually 30%, and it's been phased out with a larger contribution of the corporate sector, and so you get a good signal which corporates do well and which don't. So I think those are the two areas to watch: corporate defaults, and in my view, the retreatment or the phasing out of these employment support schemes, because that could lead to some fragilities happening.
Do you, Axel, do you think the NPL problem is going to be a serious one in Europe? I mean, are we going to see a very big rise? Are we adequately prepared for that, do you think?
I think we are well prepared, because I do think that when it comes now, you will get massive growth impetus. I mean, the numbers we have, for example, for European growth are quite a bit stronger than the ones you outlined, because I think Europe will also benefit, and this is the latest round of projections, from a massive program in the United States. I wouldn't rule out that the US will see numbers of 8-9% growth this year, and that China is already back, fully in force, and Europe will benefit from that if we keep the borders open. And industrial production hasn't really suffered. It's services, and going back, there are some bottlenecks in the global economy around shipping and freight costs, because containers are in the wrong places because shipping went down. So I think we need to deal more with the bottleneck issues rather than me having a fundamental negative view on NPLs. If we can't solve these bottleneck issues, and two important ones are also the rollout of vaccination. We'll talk about that later. If there are hiccups in that, if there is a third wave, if there is renewed lockdown, then I think the outlook for NPLs becomes, after a year and a half already being in this crisis by summer, becomes more negative.
Thank you very much, Axel. Roberto, it'd be very interesting to get your views on the levels of public debt. Are you worried about that? We're beginning to see inflation coming back, or potentially coming back. We're certainly seeing that debate in the United States. And maybe secondly, on the EU recovery plan, I think you were quite right to say that this was an impressive collective European response in very difficult circumstances. But will it be delivered on time, and will it be deployed rapidly enough? Those two questions, I think, are very interesting ones for you.
Thank you. I don't believe that the problem of public debt should be seen as now the central concern in Europe for the moment. Of course, we have to borrow massively, and for some of us, our level went very, very high. But I have also, I mean, we have learned also that the right policy mix can also limit this stress on public finance. Let me make a concrete example. When we deployed, as I said, more than 100 billion in 2020, and the calculation, the technical calculation of our expert is that summing up with the various component, our deficit should have arrived to 13%. That was, it ended up at 9.5%. So far lower, because that's fiscal response trigger better growth, less unemployment, far better tax revenues. So we contained the impact on public finance of such a strong fiscal answer. So we have the possibility to go back to levels, lower level, pre-crisis level. We said in 10 years, and this is prudent because it is based on assumption of a growth that is not at the maximum that we can have. So the variables are prudent, and if we do all well, it could be reached even earlier. But of course, there is again a condition, clear condition, that not only the combination between stimulus at EU level and the neutral fiscal standard, then consolidation at national level are well defined. So now we are at the moment where we have expansion at national level plus recovery plan. Then we will have to move to phase 2 when we have neutral national level and keep expansionary with the recovery. Then we will go, but we have to go at a certain moment to consolidation national level, offset by the expansion with the next generation EU. We will keep a slightly expansionary fiscal stance while allowing us to consolidate. And that's extremely important. And also the long-term decision, because one thing is to make temporary targeted fiscal expansion. One other thing is to address negatively some variables, a structural one. Here we have been absolutely very cautious to keep this trend realistic and possible. And then, of course, the big really issue, which brings me to your second question, is the quality of the spend of the new investment. So the quality, because this new variable, next generation EU, can help us to reconcile a prudent fiscal stance at national level and keeping expansion. So on the macro aggregate, this is really a game changer, but can become a real game changer that can bring us our public debt down and our growth up, only if you're able to make the best possible use of this money. So only if the quality and not just the aggregate quantity of these resources is optimized. So this is, if we do that, we are really, especially for countries with high public debt like Italy, a unique historic, will never be repeated in history, an opportunity to have at the same time higher growth potential, more employment, more jobs, more growth, and less public debt together. But this is only if we use this top up of our national resources in the most efficient way, doing growth, enhancing expenditures, but structural one at the same time. So and so this is crucial. Also the timing, as you said, is crucial. But here I want to say that, for instance, in Italy, but also in France, some of the program of the recovery is not yet in force, as you know. So it's not, I mean, the money is not coming because we have, all countries have to present the final programs and so on and so on. And so the actual money will start with the anticipation of 30% during the summer, and then the repayment will arrive at the end of the year. But many of us, we already anticipated some of these resources. So, for instance, we have part of the programs which are, for instance, of the transition 4.0, which is a powerful incentive to private investments and innovation, which are already working since 1st of January. We have this program of energy efficiency of private building, which again channel a private investment, which is already working. So we are anticipating with cash, let's say, but the money will arrive. And so he's already started part of the recovery. Of course, there is the risk that the necessary very granular information which are required, some kind of this procedure, because it's totally new. So Europe is a bit what we have seen in the vaccine. So it's when you do something new, you have to be a bit more prudent, of course. You have not the normality of a national administration. So they rightfully, they want to check out everything, every program, every detail. So they're asking a lot of information. And I know those who are writing those information in all countries, there's a lot of work. So this is a bit bureaucratic. But we have to know also that is necessary because it's the first time. So I hope that it would be a bit more fluid and will help not having delays in the actual implementation. And then we need. Let me react also to something that both Axel and Elke said about NPL. I fully agree that I don't think we will have a massive problem with NPL. We'll have an increase in NPL, of course, but I think it would be in our baseline scenario manageable and more. I mean, as Axel said, that we have to look at bottlenecks as a specific area, more general, and of course SMEs and of the sector which are more affected are the natural candidates. And so here in our baseline scenario, we don't have a big problem, but we have to be prepared also to the less favorable scenario. And here we have something to do yet, honestly, in our what is our toolbox. So I don't think at all we have to change the way in which we measure the healthy situation of bank balance sheet. There are some, I got pressures, we have to change this. No, I think this is unhealthy because you have to recognize when you have a problem. Market have to perform the function. You have to see things. You cannot hide things. But where I see area of improvements is exactly what we're referring to, the national asset management company. So here is the problem. The point is not that, of course, losses are losses, and you cannot make losses disappear. But if you allow a national asset management company to buy NPL at real economic value and long-term value, and you can avoid the risk that a market failure, so a temporary distress market value, produce a negative chain of events. So this is not wasting public money at all. But what we have now prevented by this, by a regulatory element, which says that if you do that, you trigger resolution because this is state aid. So it's a long-term versus short-term. So this is, I think, where we need to fine-tune. It's just a matter of how we read and we use our state aid communication, because if we prevent this to happen, then we might be without a necessary tool in case we have an increase of NPL, which is far better than other tools. And then for the small banks, again, we need to do this double movement. On the one hand, more harmonization. On the other hand, avoiding filling this gap we have, where for the big we have built a crisis management system. For the small, we have only atomistic liquidation. And then it cannot work. So we need, big, like in the US, we need this alternative preventive measures to be applicable. So I see these two targeted improvement to our toolbox, a way of complete it and to make us ready to be prepared to all the scenario. And then, of course, there is the bigger thing. Again, Elke was referring to it to address this famous almost tensions, which is a very problem we know very well and keep recurrent. And this is more ambitious, of course, because we all know what we need to do if we want to address this problem. This is a big political trade-off between national guarantee of deposits at euro level and removal of this barriers to cross-border integration, flow of capital.
Yeah.
So this is the more difficult. The two first things I said are controversial, but I think can be done in a short term. The third one requires a big political work, but we did the recovery plan, so I think now we are able also, hopefully, to finally address this, this big trade-off.
Thank you so much, Roberto, and very briefly, Axel, if I may, because we're running as usual very short of time. Can I just get your views on 2 points very briefly? First of all, do you agree that Europe has to accelerate its banking union, its capital markets union, its delivery of the European recovery program? I think many people have this concern that things are just moving fast enough. That's my first point. And the second one is, where would you focus the EU recovery plan? Where do you think there's going to be the biggest bang for the euro? And if you could be reasonably brief. Thank you, Axel.
Look, I'm trying to be very brief. On the European funds, I think it is important to do two things that are useful in the long run. Some stuff is expensive, infrastructure investment. If you talk about greening the economy, if you talk about IT infrastructure, Europe is lagging the US. We need to invest heavily in these areas, and we should do that with a longer run view of supporting the economy's long run growth potential. So all of the stuff around infrastructure and investments are key. They're going to pay off in the future. It's an expensive road, but now is the time to do it. Second point, there's stuff that is cheap and has long run effects. It's called reforms. They need to kick in now, because there's no better way to do reforms than at a point in time where the economy is changing. COVID has been a catalyst for many changes. The economy after COVID will not be the same as before. So we now need to put reforms to facilitate future trends to kick in. There are a couple of long-term trends. We know them, but we need to act on facilitating them. And Europe, sustainability is one, because I want to be short. Europe has started with a European set of rules that were the first at the global level to define standards. We need to push that, and it needs to be exportable. It needs to be a global product push, and I think sustainability is key. It's great to have the US back at the table to negotiate. Now is the time to do this, and reforms and putting money on future trends is not going to be as expensive, because these are huge dynamics, and growth impact will be much faster. What Europe needs to also do, in my view, banking union, capital market union, yes, all of that. We should have done it after the financial crisis. We need to do it now. And I think we need to learn from those that have built strong capital markets. The US is one of them. I would start with basically undoing all of the unnecessary barriers. Create, as I like to call it, a banking union with a bang. Create a pan-European league of banks. The US have their foreign banking operations, and all of the foreign banks have a ability to incorporate at the federal level and work across the US, and domestic banks as well. We need to create a European league of banks and focus on undoing the 27 market barriers and AML, KYC procedures. I could give you at least 5 areas where basically national regulation and fragmentation still stands in the way of a banking market. You have to do that by creating a European league from scratch. Then basically you have banks incorporated at the European level, supervised by the single supervisor, subject to one law, subject to one resolution fund, subject to one resolution procedure, and European law. And I think that is something that we need to do. And I think Brexit can be as much a catalyst for that as, in my view, because many banks will try and have a second leg in Europe, somewhere on the continent. And I think we need to give them the ability to do that now.
Well, thank you, Axel, and thank you, Roberto, for a really fascinating discussion, and quite a positive discussion, I have to say. I think you're more positive than I am, but that's very good. And I think you're absolutely right, Axel. This is the moment to move forward as the economy is changing. And so I thank you both very much on behalf of the council, and hand it back to our organizers with a little apology for running a little bit over time.